Hi, my name is Bo Rogers. I'm a mortgage loan officer. My NMLS number is 620948. And I've tried to set up in-person home buying seminars. Not necessarily first time. It seems like everybody does the first time home buyer seminar. I mean, you could be a person that's bought a home in the past. Maybe it's been a decade, maybe it hasn't. But I wanted to do a seminar that would be helpful. And I put it out there several times. Never had anybody react to it, so I just figured, hey, we'll make a video for it. And maybe a lot of people are just more comfortable, maybe not face to face, whether they don't have the time to do it. They can always come back and look at the video and decide how they want to get their content. So this is one way. So what is the first step in buying a house? Well, the first step is actually deciding to buy a house. What has led you to that decision? In my case, the first house I bought, what led me to that decision was I had an abundance of money in the bank and I was tired of paying rent for a place I was going to have no equity in and had no control over what I could do as far as the inside, outside. But I wanted to make a good investment, and I'm sure you do too. Who doesn't? Did you know that the financial worth of a renter is $4,000 and that of a homeowner is $184,400? Buying a home's going to be the biggest decision and largest investments that you're going to make, and it's the number one step that's going to get you to being wealthy and not just being a renter to where you stay in the same status or lack of money over the course of time. So once you decide to buy, and here might be another reason why to buy, is because homes do appreciate, not depreciate. And your payment is always going to stay the same in a home. Your principal and interest will always stay the same. Taxes and insurance may go up, but your home is appreciating in value. In general, they were saying 6% a year. So even if your interest rate's at 6%, really you're breaking even because the home's appreciating at the same rate. So when you sell it, I've always said that you make your money in buying a home if you get it for the right price. That's how you make your money. Now, recently, since COVID, so since 2020, homes have been appreciating like this. Not a steady, but like this. So I don't see it changing anytime very soon, but homes appreciate, not depreciate. So invest your money in your home, not a car. Trust me. So the first step is obviously to decide to buy, and what's going to drive you to that factor is that your rent keeps going up and up and up to where it may be equal to a mortgage payment. Because of the appreciation in a home.
Can you tell me the difference between what you said appreciation
Right.
and depreciation, correct?
So a depreciating asset would be like a car. So you buy a 2024 model car, they say as soon as you drive it off the lot, you've lost 10%. That's awful. So it's a depreciating asset. It's going down in value. Appreciation means it's going to appreciate. It's going to go up in value. You're going to be able to sell it for more than what you paid for it. That's step 2 would be to get pre-qualified for a home. It's not to start looking on Zillow at houses or calling your real estate agent. The second step is actually to see what you can actually afford. This can be a friendly conversation to where nobody's going to pull your credit. If we're going to pull your credit, we're going to tell you when we're going to pull your credit because we have to have your permission to pull your credit. So it's not just an instant credit pull. And I think a lot of people have negativity about the credit pull. When it's for a home mortgage, it's not going to affect you for as much as what you think. I'm not supposed to tell you how it affects your credit because I'm not a credit expert. Even though I know and look at credit reports all day, every day, I can't tell you how many points, but you can Google it. Just Google, what will it do if I pull credit for a home mortgage? First step, secure financing. Check with a loan officer that you know, like, and trust. make a loan application or get pre-qualified. A lot of people say, oh, I'm going to get pre-approved. The first step is actually to get pre-qualified. The difference between pre-qualified and pre-approval is a pre-approval has to go through an underwriter. They've already looked at your documents. They have already made a decision after looking at those documents. Does this loan work with the guidelines from the investor? All right, so now you're pre-qualified. I'm always going to push you for pre-approval to go ahead and get your documents. We've run your credit. We know what you can afford, and you don't have to max it out. You don't have to go in being house poor. I say that, but just remember, if you're like in your mid-20s, your income is probably going to increase over time, so you can probably afford a little more when you're on the up and up. Now, if you're my age, you just want to maintain steady to where you know exactly what your mortgage payment is going to be, especially if it's principal and interest. But the only thing that can cause the true difference is taxes and insurance. And recently, insurance is really insane. So it's sad, but it's one of the things in owning a house, just like anything else. Your car insurance has gone up, homeowners insurance has gone up, and you can kind of prepare for that. But over the last 3 years, my homeowners insurance went from $1,800 a year to $2,400. This year, it's $3,800 a year. But it's still cheaper to own my house than it is to rent, because guess what? Same thing happens to the renter's insurance with the people that own apartment complexes or condos. Their insurance goes up, cost goes on to you. So that's one of the beauties and advantages of owning a home. At least the only part that's going up is things that are in your control and you can shop for. And you should definitely shop for homeowners insurance every year. Fight your taxes with the county every year. Homestead that property because it'll give you a tax relief. And I think you're still going to find that the numbers are still cheaper than renting. Now that we're pre-qualified, you're going to get pre-approved because you're going to send me documents. We're going to get you to where when you have an agent, y'all make an offer on a house, I want to be able to talk to that listing agent to say, hey, my client has already been through underwriting. Would you like to close this loan in 15 days? We have the ability to do it because you're already approved. We've already seen all your documents. Now all we got to do is approve the house, order the title work, and be done with this process and get you to the closing table and get you the keys to your house. Important part of the process is choosing an agent. Choosing your lender is important. We're just all nerdy guys that know numbers and know rules. But your agent is somebody that you're going to work with on the daily. You will build a relationship with your realtor, even if you're the most inverted person on the planet. Like, they're going to drag what you want, what you're looking for. And man, computers have made it so easy to find exactly what you're looking for. So always be super honest with your real estate agent. In choosing them, make sure that they have the right personality for you. If you get a bad vibe, run, because there's a ton of other agents. And if you need the help of a mortgage loan officer to find your agent, I know their personalities. I've spent a lot of time with real estate agents. Your mortgage lender can help most of the time to find the right agent for you. And I'm happy to help. I know them all. In a mortgage loan, there's basically 3 different factors, okay? So think of down payment, because you're gonna need money for down payment unless you go with a down payment assistance. If you're a first-time home buyer, you have a credit score over 680, you may qualify for down payment assistance, and they can do 3%, 4%, and they can do 5%, all the way up to 6%. So down payment, you really need to save money or you will have to get into the down payment assistance. There are other ways to get money for down payment that a lot of people don't think about. You can always ask for seller concessions. So on a conventional loan, if you're putting down, say 5%, up to 20%, you can ask for 3% seller concessions. If you're putting down 20%, you're avoiding mortgage insurance. You can ask for up to 6% seller concessions. There's also, and that's on a conventional loan for a conventional investor. You can always do an FHA loan as well. FHA requires 3.5% down, and you can automatically ask for up to 6% seller concessions. VA loans require 0 down. So if you have served in the U.S. military and you are eligible for a VA loan, it is a 0 down loan. You can do a conventional loan with 3% down if you're a first-time home buyer with a 680 credit score. You do have to take a little class to be able to do the 3% down, but it is an option. Another thing that you want to save for is an escrow account for taxes and insurance. A lot of people don't think about, wow, I'm going to need money to do this. But when it comes to your insurance, insurance is paid ahead of time. So not in arrear. Taxes are paid in arrear. Your insurance is paid in advance to where you're going to need 15 months of insurance up front. So they charge you a year automatically, which covers you for the first year of the house. But you also have 3 months in reserves, which goes into your escrow account for the next time insurance is due. When it comes to taxes, taxes are paid in arrears. So right now it is 2024. I paid taxes for 2023 on January 16th of 2024. So I paid last year's taxes. So they are going to collect a certain number of months of taxes when you close on a home. It depends on what month you buy. Taxes are due in January and you buy in June, that's 6 months of taxes. But the beauty thing is the person that sold you the house, they have to pay from January until you own the house in June. So taxes and insurance, you're going to need money for it. Down payment, you're going to need money for. We're going to negotiate when it comes to rate. Like everybody always only sees rate. That's all they know. What does it cost to get to a rate? You can have any rate that you want because there's a big rate sheet and it tells you how much you can buy it down. So if somebody called me today and said, hey, I'd like a 5% rate. Is it possible? It is possible. But what does it cost to get there? And you have to do the math to see what the break even is, to see if it truly makes sense. A lot of times it doesn't because people get into the, wow, I've got a really low rate, and it becomes kind of almost like a pissing contest with your neighbor. Oh, I've got a 2 point whatever rate, and your neighbor's like, ooh, but what did it cost to get there? Because when you close on that and you buy a loan down, you're paying money to buy it down. And is that money worth it? Especially with inflation, because a lot of people don't think about inflation. And if inflation's at 2 point something percent, your dollar today is worth 2 point whatever percent more than it is in the future. So you really have to look into it when you buy down an interest rate. The other thing is the term of your mortgage. They do 30-year terms, they do 25s, they do 20s, 15s, 10s. You have ARM products. There's a huge slew of products. So you want to make sure that you're in the right mortgage and doing the right thing for you and your family. So now you're pre-approved, pre-qualified. Now you're out looking at homes. Now everybody thinks that they're going to find this miracle home. Sometimes you're not going to find this miracle home. You definitely want to put an offer on the one that you like the best, but they're not all perfect. Even if you go to a customized home builder and have a home built to your specifications, a lot of times it's not going to be perfect, but you definitely want to think about the best home for you and the workability that you need into a home. So you're thinking of the priorities that you have, like if you want an open kitchen, that's important to you, the bathroom is important to you. But I'm going to talk later about return on investment, because a home is an investment, because we've already said that we want to build wealth. That's the whole purpose of owning a home. If not, we'd all be renters, because who wants to mow a yard? Not me. Actually, I like mowing the yard. I take that back. And the painting and the upkeep. But you have to budget for that. And just remember, it's an investment. It is a money maker. And I can't live anywhere cheaper than I live here. I guarantee I've been here for 13 years and I can't live anywhere cheaper. So the next step is to find that home, and you're going to go out and look at several different homes. Your realtor is going to hook you up with a search on the NMLS, and it's going to get you to where you want to be. You're going to make an offer on the home. They're either going to accept or decline. Don't get heartbroken if your offer doesn't get accepted, because my first offer didn't get accepted. I was heartbroken. It hurt. But the second house I found and made an offer on was even better, so it was a good investment. So you want to be out there looking at homes, know what you want, have something in mind, get along with your realtor. You're already pre-approved or pre-qualified. Here we go. So now you've made that offer on the home, and now it's an accepted offer on a home, and now we're in that 30-day period is what most people choose when they buy a home. They have 30 days to have financing done and get you to the closing table, which is not a problem because we've already done our due diligence and got you pre-approved. So now all we have to do is approve the home. But the first thing that you want to do is you want to pay for a professional home inspector to go to the home, inspect everything. Inspectors are amazing. Like, they will go to every outlet that's in your home, test the plugs. So look up in the attic, make sure the HVAC system is up and running properly and up to code. A lot of homes sometimes cannot be up to code, and there needs to be a little adjustments. But by having it inspected, they're going to give you a page book of stuff that's right or wrong with your home. So you'll take that into mind. And remember, even after the home is inspected, you can still have sellers take part in giving you money to fix things that may need to be fixed. Let's say the inspector goes and finds that the roof's bad, because they're going to look at it. If they say, hey, this roof is 10 years old and there's hail damage everywhere, it's going to be in the report. If they see any form of foundation crackage or little cracks that are in the wall, is it due to settling or is it actually the foundation? This is where the inspector pays off, because this is something they do every day, all day. And I've never had anybody say, wow, my inspector, well, I won't go there. There are good inspectors. Take the advice of either your realtor, as long as they've been a realtor for a long period of time. That means they've seen a number more experience, more things you've seen. Or if your mortgage banker or a loan officer has been in a business for a long time, they're going to know a good inspector too. And it never hurts to look at Google reviews. It really doesn't, because you're going to have the home inspected. Make sure that you're buying the right product. Even when I buy something that's really little on Amazon, I shop it, look at it, make sure people are happy, look at the pictures, look at the video about it. I mean, it could be just a cheap object, but you want to make sure that you're doing the right thing. So once the home is inspected, you're going to get the inspection report back. You have time to negotiate if anything needs to be fixed. So after the home's inspected, we know it's good. You're going to start shopping insurance policies immediately. The first person you call is probably who you have your auto policy with, because you already have a relationship with them. So make that first. Ask your mortgage person, loan officer, banker, whatever they are. Ask them who they have in mind for insurance, because guess what? We've seen a lot of insurance, and we've seen a lot of different things, especially doing all the refis that I did in 2020 and 2021. I've seen a lot of different homeowners insurance and know what they cost and know what the deductibles are. Ooh, deductibles. You definitely want to think about deductibles, because hell and wind policies have gone up to where there used to be a standard. I mean, well, I'll say that. $500 deductible, then it went to 1%, and then it went to 1.5%, 2%, 3%, 5%. I mean, it just depends on it. You have to shop it. Trust me on that. So now you have your insurance policy in place. We've already ordered the title work. Title works come back. Now it's time. We have you cleared to close. You're ready to go. The appraisal came back from the house. So I mentioned inspection. That's just for you. Appraisal is for the bank. So an appraiser does almost the same thing as an inspector, but the inspector, I think, goes a lot deeper than the appraiser does. Appraiser is looking at market analysis to make sure that the value is truly there for the home, make sure the home is safe and livable, and that there's no major problems or malfunctions. Your inspector is actually looking at every appliance thinking this appliance is 7 years old. This appliance has a time frame of 10 years, so you probably only have 3 years left on it from the wear and tear. So the appraisal is just for value. So once we meet value, you're done at that point because you're going to be cleared to close. We have your insurance policy. We've already gotten the taxes. So we put everything in place. Everything works. So now we're going to get you to the closing table to where we put out the paperwork to the title company. And this is where you actually get final numbers. Everybody will ask you, like way before we even get here, hey, how much do I need to bring to the closing table? The final is going to come about 3 days before you close. But before you close on that home, you are going to do one final walkthrough to make sure that the home is good. And the next step is your trip to the title company. Now, this is where you're going to go and sign on this home. It's going to take about 45 minutes to an hour. Depends how much you like to talk and how much your title agent likes to talk. Is the paperwork there? Our bank is really good about getting paperwork there and getting it there on time. It's a smaller group of paperwork. The larger banks I worked at had bigger stacks of papers, and it took longer because you didn't have a personal relationship with your closer. My closer's name is Felicia. She works in the office that's right next to mine. So I always get a kick out of saying bye Felicia every time I see her, because bye Felicia is back in my day. Well, never mind. So you close on a home. A lot of people ask, hey, do I wire money or do I need a check? I prefer a check because if you wire money, there's been scams out there to where, somebody will call you and say, hey, I'm from the title company. If we do this today and you go ahead and set up the wire, we'll give you $1,000 off your title fees. But hey, the routing number has changed. Here's the new number. And then you transfer to that number, and it wasn't even a person from the title company. So when you go to a title company and hand them a secured check and your ID, you're at closing, you're signing, they're going to go through the mortgage part first, and then they're going to go through the house part, and then you're going to sign, then you're done. And then it takes about 1 hour for funding, and then you get your keys. The house is yours. Now we're back for Q&A. So Nicole has never bought a house before. I've purchased 2, and I've been part of purchasing thousands. Like, I've seen over 1,000 transactions, and you kind of know how it works. What questions do you have about buying a home?
Okay, so you mentioned seller concessions. Can you explain what those are? Like, very simple.
Sure. Seller concessions is where you put into a contract, hey, I agreed to buy the house at this price, but I need 1% seller concession. So the house price is $300,000. That'd be $3,000 at 1%, right? And then at 2%, it'd be $6,000. At 3%, it'd be $9,000. And what you are entitled to ask for, which could help you with down payment. You can use that money for down payment money. You can use that money for escrow for your taxes and insurance. You can use that money for closing costs because of the title fees. So
where does the money come from, though? Does it
the
come
seller.
Off, like, it doesn't come off
the house price?
The price. No. Okay.
No, it comes from the seller. So you agree to buy this house at $300,000. And
I'm asking you for $3,000 to fix some stuff.
Yeah.
And you give me $3,000.
So a concession's 1%,
okay.
right
That's
there. And you can go all the way up to 6%. But here is something about seller concessions. You do have to use them all because they're not going to give you money back at closing. So you do have to use them all. A lot of people will also ask, what are other ways to get qualified, as far as down payment and things like that. If you can have money gifted, so money can be gifted from a family member. It does have to be a family member. So it can be a brother-in-law, sister-in-law, cousin, mom, dad, obviously, brother, sibling.
And you have to have a gift letter explaining where the money came from, if I remember.
Right. So you do have to have a gift letter. We're going to need 1 month banking statement of where the money came from because we want to make sure it's legitimate money. You're not doing illegal stuff to get money. That's why they ask for that. Yeah. Seller concessions, money can be gifted. You can also, what I did when I refinanced this place is I did do to where I didn't take a par rate or the best rate I could get. I actually did a rate that was a little bit higher because it actually gave me money back to use towards closing costs to where it was cheaper. you just have to do the math to see what makes the most sense. Because, I mean, once you get down to an interest rate that's really low, you're fine. A lot of people also ask about, hey, you know, I want to pay my house off early. So that's another question that gets asked, or people tell me all the time, I want to pay this house off early. Now, if your interest rate is at 6%, okay, or lower, why are you paying your house off early when you could take that same money and invest it?
Yeah.
Right, because on average, like the average investment makes 6%. That's average over the years. You know, they have statistics that go back, what, like 100 and something years. And if the average is 6% and your interest rate is 6%, you have a deduction when it comes to your home, and you're still evening out when it comes to interest rates. So don't, for instance, my house is at a 2.875 interest rate on a 15-year fixed note. I'm never going to pay it off. Why? Because my money is invested, and so far this year, I think my money's made 13%. Granted, I do have to pay the investment banker or financial planner. I do have to pay them 1 point something percent, but I'm still way ahead. If I'm at 13%, let's say I pay 1%, I'm still 12%. And if I paid off my mortgage, let's even it out to 3%, I'm still 10% ahead or 9% ahead. So you don't pay it off early.
So if you have the money, it's better to use it to invest,
Yeah.
earn more money, then you'll have more money in the long run.
Yeah. Most
versus
definitely.
paying things off.
Build your wealth. Build your wealth. Any other questions?
I think that was the seller concessions was the one I wasn't positive on. I wasn't sure.
What credit score do you need to buy a house?
680. Oh, to buy a house?
Yeah.
I was thought to qualify for the loans. I'm not sure. I just got a credit score like 2 years ago.
So 620 right now. They say like on
620?
some loans that there's no specific credit score, but 580 is as low as I've seen on an FHA or VA loan. So 620 is the credit score, and then the tiers that I find in pricing, like so your credit score does affect pricing. So if you have a 850 to 740 tier A, and then once you go down from the 740 to say so 739 to about 680 would be B, and then 680 to 620 or 5 is C credit. It does affect your interest rate and availability to buy. And in some products, you are going to have reserves when it comes to a loan, especially based on credit scores. So if you have not so good credit, you may be asked to have reserves, but you can use like 401ks and things like that for reserves.
And you also know, we both know lots of different ways to help you with your credit.
Yeah.
So if you have a question, let us know.
Yeah.
Let him know, and he can at least help you get a plan in place to be ready to go through this process, whether it's your first time or you just are looking at planning for the future to be ready to go maybe next year, next summer, but you need to get it, you do need to start ahead.
Yeah.
And he can help make that plan for you. He's very good at it.
We want to thank you for watching. We hope that you got something out of it. If there's anything you need, my information is right here. So give me a call, shoot me an email, send me a text, whatever you need to do. My name is Bo Rogers. I'm out.